Hello everyone, and welcome to this evening session of Quantopian Book Conversations. We are very pleased and honored to have Igor Halperin with us tonight, and we will be talking about the book that he co-authored with Matthew Dixon and Paul Bilokon, if I pronounce Bilokon's last name correctly. I won't take much of your time, Igor. Thank you very much for being here, for being with us. I just wanted to give a very, very short introduction, but I will be asking a little bit about the past and the history and physics days and finance days, so we can also add to that discussion, during the discussion. But Igor is currently with the AI Asset Management Group in Fidelity Investments, and he has been there since, I think, January 2019. Before that, he was the principal owner of Invisible Hand Computing LLC. And before that, research professor of financial machine learning at NYU's Tandon School of Engineering. Is that still going on in some form of?
No, well, these two things were done simultaneously when I was at NYU. And when I joined Fidelity, I stopped.
And then I think before that, you were the executive director in Quant Research Group in JP Morgan Chase, and then Bloomberg before that. But reminded me of good Canadian days because I got my PhD in Canada. So when I saw the British Columbia
Oh,
postdoctoral years, wonderful to hear that. He was the researcher in theoretical high energy physics in the University of British Columbia in Western Canada. So today, as I said, we're going to talk about the book that he authored. The book is called Machine Learning in Finance: From Theory to Practice, published by Springer. It's a wonderful book. I just absolutely love this book, and partially it is a book that we chose for a Quantopian course that I'm offering this semester. So one of the textbooks is this, and the other textbook is the Advances in Financial Machine Learning by Marcos de Prado. So again, thank you very much for being here tonight with us. And let me then ask you maybe to start with this journey from physics to finance first, before we get to the book, if you don't mind.
absolutely. Yes. The journey started actually when I was in Canada at UBC.
Right.
So I was on my postdoc, and back then I did high energy physics, but high energy physics has, few branches.
Oh.
And back in the day, the only few jobs in academia were for those who did string theory.
Mm-hmm.
And I didn't do string theory. I did what is called the particle phenomenology, theory of strong interaction. There were essentially no jobs. And then, well, actually, the actual story is interesting because back then there have been some conversations, and a couple of my colleagues at the physics department, they apparently also were thinking about, finance. And the very first thing I've heard about finance, someone told me, oh, all finance is essentially about solving one partial differential equation with different boundary conditions. And I thought, it doesn't sound too exciting. Yeah, but then, yeah, and then I started to think. I went to the bookstore of UBC and looked into books in electrical engineering. It was all Fourier series,
Yes.
also didn't look too exciting. And then someone told me that, I have to look into finance books. So I took two of them. One of them I couldn't read because it was heavily mathematical, Duffy, Asset
Oh, yeah.
Pricing Theory. The other one I didn't like either. It was a book, John Howell's book.
Oh, yeah. Mm-hmm. Yeah.
Howell's book is considered like, classic, but nevertheless, it's not the style, for physicists, right? So because it immediately jumps into examples, etc. So I was not too impressed. But back then, what actually swayed my, like what made me think that it should be a good thing to try was that around the same time, physicists started to work in finance, and the discipline called now econophysics
Yes.
came up, right? So Jean-Philippe Bouchou was one of the pioneers of that. So I looked into these papers and I thought, oh, this is interesting. Like, I mean, like these are, equations and formulas. I can relate to that. I can understand to some extent. So maybe I'll try. I'll give it a try. That's how I ended up in finance. And then the first job that I got was at Bloomberg.
Right.
So the first, assignment that I got there was in modeling credit.
Mhm.
So since that days, the next, 17 years after that, I spent doing mostly credit. First at Bloomberg and then at JP Morgan. That's the story how I got into finance. We can talk separately about
Sure.
how I moved from finance to machine learning.
To machine learning. Yeah, yeah, but that's very interesting. Yes, and I agree with you. I very much appreciate the work that is being done in econometrics. In particular, the part of it that, I mean, every part of it, random matrix theory part of it, particularly, I really liked very much, and the relevance that it has to finance. And again, Busho and a couple of others had written papers on that, and the book recently came out by two of them, I think. And there was also market microstructure studies. Like it has become one of the pillars in that field. And not the only one, but econophysics has started to really, really sound like a very valuable approach to that whole field, which is really very interesting to see. So it is not really surprising. I mean, like you see many of the Wall Street people, the researchers and quant researchers, even going back many years, were in the fields of physics. I think majority were physics PhDs, and then some math and statistics, and then computer science and so on with the Isha.
Yes.
Yeah.
Exactly. Around these times, they haven't been yet, financial engineering programs. So most of my colleagues, indeed, like many of them were physicists, some of them were mathematicians, but no one had professional training. We
Right.
all were amateurs,
Right.
essentially.
Right. In that sense, yeah, in that sense. Yeah.
Yes.
Okay, so now if you could tell us the journey of the book, the genesis of the book, how you started thinking about writing this book in your mind and with your co-authors, what was the goal? What did you like to achieve by writing this goal? And I can see the impressions of physics throughout. But if you could also talk to that and how your physics background, because others, I don't believe, like Bilokon, I think he got Imperial College, PhD Imperial College in computer science, if I'm not mistaken.
Who you talking about? Whom?
Paul, your co-author.
Paul, yes. Yeah, Paul
Yeah.
is a mathematician. Matthew is also a mathematician.
Oh, okay, okay. So the physics influence comes from you then, right? You have a
That's
great.
me. Well, actually, the idea of the book came actually from Matthew.
Oh, I see. Okay.
So he reached out to me and said, "Hey, I have this idea of writing a book." His main idea was try to connect machine learning with traditional financial theory, right? So make this, smooth connection between parametric models that we have in classical finance and non-parametric models. And I like the idea because back then there haven't been anything like in this style. And now my own part, I wrote few chapters in the book, a
Yeah.
few last chapters. Matthew and Paul wrote few first chapters.
Okay. Okay.
My chapters were only on reinforcement learning, chapter 9, 10, and 11, and 12.
Okay. Yeah. Yeah.
And basically, like maybe it will be of some interest if I tell you like how I came to reinforcement learning.
Yes, very much so. Yeah.
Yeah. Well, first how I can, first how I got this bug of machine learning. So like I was at JP Morgan, and almost immediately after I started to work at JP Morgan, I came across some books on machine learning, specifically across the book by Bishop,
Yes, of course.
Pattern Recognition. But I only read few chapters in there. I was very much into some stuff which are, considered maybe like non-parametric statistics. Some people consider it machine learning. Specifically, I mean, I'm talking about maximum entropy methods, which are extremely, powerful thing. Like maximum entropy methods, I applied them many times across many different problems, and they always work wonderful. But because I did theoretical physics, like, I was always scared of machines. So there've been some chapters in this book about machines. One chapter was called Support Vector Machine.
You're
And I thought, oh, it's about machines. I would not read this chapter until someone told me that actually support vector machines were state of the art back then. So it was like When I came to JP Morgan, I started in a model validation group where we had to look into, models developed by quants. One of the very first models that I had to review was neural net. So I got familiar a little bit with the neural net, but then I was told that actual state of the art is support vector machines. So I went back to this book and I found that it's not about machine in the sense of mechanical machine. It's something very beautiful mathematically. So I really liked it and I applied it again to a few things. So I was very much into machine learning, but somehow because we didn't have established, machine learning groups there. So I was basically on my own. And somehow I missed the deep learning revolution. Till one of my colleagues came to visit from Benjin's office and he said, "So are you doing deep learning?" I said, "What is deep learning?" He said, "Whoa, how come you don't know? Here's the article in New York Times." Like, wow. And then I became, so excited that like, you know, very often when you're new to the field, you get overly excited, right? So because you don't know what it can do. But after I read it, I thought, oh, it's like, let's forget all classical models. Let's forget all credit models. Why do we need to, model specific financial ratios and use them to model defaults? Let's just, deep learning do it, like construct features for us. Yeah, so I started to promote this, and my manager, he was skeptical, but he didn't tell me no. So he gave me some freedom to try, and I tried, and it didn't work. I mean, deep neural nets did not work.
Right. Yeah.
P-layers network did not work, and I couldn't understand why. Like I started to simplify. Eventually, I ended up with just one layer network logistic regression, which worked well. Like there was no need in additional layers because the data was not that large, because there were lots of noise in it, blah, blah. But nevertheless, I got into this thing. And then at some point, we also had some interesting project on pricing and hedging in incomplete markets, which is already, if you think of it, it's like stochastic optimal control
Right.
problem. Right. So depending on how you frame it, it becomes more or less similar in the spirit of reinforcement learning. We've been trying to develop one of the models by Jean-Philippe Bouchou. Yeah, he had a very nice paper, beautiful paper. He told me that he was very proud of this paper when I met him in person. It was called Hedge Monte Carlo, a paper from 2001. So we tried at JP Morgan, we tried to, develop this paper further, generalize it to multiple dimensions, etc. And so I was very well familiar with that. And then it came up again when I finally left JP Morgan because I wanted to do machine learning.
Right.
There was not much back then. And initially I left JP Morgan. I thought that I would join a startup. Startup didn't start because we didn't get money. But then this teaching opportunity came up, and Peter Carr, the late Peter Carr, told me, okay, why don't you create a course on machine learning in finance for NYU and Coursera?
Yeah.
And you will be self-financing professor. We will not pay you anything, but you will be getting royalties from your course. Okay, fine. Let's give it a try. So I started to work on this course, and it was actually specialization. Actually, it runs till this day.
Yes, it does. Yeah.
It's still available on Coursera, even though I'm not involved almost like since I left it. And so it, runs autonomously.
Yeah.
And it was a specialization about machine learning in finance. The first course was very, very general. The second course was more about technicalities of machine learning. And the third course was about reinforcement learning. Reinforcement learning was my most favorite thing.
Yes.
So I wanted to make part of this specialization about reinforcement learning. And at some point, when I started to do it, I realized that it was very, very hard. The hardest part was to come up with assignments, because in Coursera framework, you have to, structure your assignments in such a way that it would be graded automatically by scripts.
Right.
Because it's, yeah. So, and this, imposes lots of constraints. And also you have to prepare these assignments. So at some point I understood that I'm totally behind the schedule, that my ambitious projects look like totally unrealistic. And I thought, okay, maybe I have to simplify things a little bit. And then I recalled this previous project from JP Morgan about this incomplete market.
Right.
And I thought, oh, maybe I'll just, present option pricing as reinforcement learning because it's so obvious. Maybe somehow I was under the impression that it's already known to everyone, and there are already some, articles or tutorials how to do this. Like it was obvious to me that option pricing is equivalent to Q-learning, what is called, not just reinforcement, particular Q-learning. I started to do search, nothing. So this combination, nothing. Then I said, wow, well, actually, no one understands it yet. So let me write a paper. Put it as a, assignment, a simple project, very conceptual one, very simple to understand. Yeah, so this is what I did in this Coursera course. So when we decided to write the book, I said that I will cover chapters about reinforcement learning and something which was even more interesting to me, something which is called inverse reinforcement. Actually, my interest in reinforcement learning was due to my interest in inverse reinforcement learning. But to solve the second one, you have to first address the first one, right? Because almost by construction. Yeah, so I wrote a few chapters explaining this on simple examples. First reinforcement learning and then inverse reinforcement learning. In inverse reinforcement learning, I got overly excited and I wrote almost 100 pages just on this topic. And then Matthew said, okay, what should we do with that? Oh, let's keep it. Yeah, so that was the story about the book.
Oh, excellent, excellent. So how do you see it now? How do you see that interaction of the financial, in general, in the larger scheme of problems or issues that arise in financial markets, and how reinforcement learning or inverse reinforcement learning is successfully handling them? Since you wrote the book, or like your experience from the time that it evolved, do you see more problems being solved by these techniques? Do you see major challenges to these techniques that cannot be handled, need some, extensions of the current techniques, or how do you see it?
Yeah, many great questions. So, well, actually, okay, we can maybe talk separately about
Yeah.
what I did at my job versus what I see at the
The outside, yeah.
outside, right? Starting with the first one, we did some interesting projects at work around different approaches with reinforcement learning. They mostly stayed as research projects for various reasons, not for any profound reasons, I would say. Mostly for, operational reasons that, Fidelity is a fundamental shop, which didn't do back then much of, systematic trading and things like that. Reinforcement learning is still more about, algo trading and systematic strategies. Having said that, we did some very interesting experiments. Projects. We wrote a couple of papers and filed a couple of patents on applications of reinforcement learning. One of them was very interesting. It's actually published in the paper. The paper is in Risk magazine, also online. That was actually the one of my most favorite ideas that I wanted to pursue, which deals with combination of direct and inverse reinforcement learning. So maybe I should explain what for the audience
Yes, that would be great. Yeah.
what inverse reinforcement learning does, what it is. So and maybe I should start with direct reinforcement learning first, right? So what is direct reinforcement learning? Reinforcement learning deals with problems of optimizing actions of an agent extended over a period of time. So that's the first difference from other branches of machine learning, such as supervised learning or unsupervised learning. Here we deal with something which extends over time, right? That's difference number one. Difference number two is that in supervised and unsupervised learning, we deal basically with problems of understanding something about the world, classifying, making regression, but not changing the world. Just right. In reinforcement learning, we deal with optimizing actions of an agent which can change the world. Not necessarily depends on your specification. If, like, in financial setting, if you're a small trader, then your trades would not move the market. So you would not be changing the world by your personal trades. But if you're a large asset manager, you will be changing market prices, right? So you will change the world. So and provision for this is very important, and it's built into reinforcement learning via what is called feedback loop. All right. So reinforcement learning deals with optimizing actions of an agent which are, intended to achieve some goal. And this goal, how you formulate this goal, you formulate this goal via the notion of the reward function. So reward function is essentially like, in classical finance, we talk about utility function. So reward function is the same as utility. Usually you apply it, sometimes people, when you talk about utility function, sometimes you only talking about the utility of the terminal state, of the terminal wealth. And sometimes you're talking about utility of each, time step, each small time step. So in the reinforcement learning setting, it's the second case. We usually talk about, like, the most classical case is that you get a reward from each, time step, from each action taken at each time step, right? And your ultimate goal is to maximize the total reward that you accumulate over the total course of action. But obviously, like, because it's extended over time, right, your reward will be a function of the future. You don't know it, so you can only maximize it in expectations. And this gives you what is called value function, which is exactly like total expected reward from your actions, right? And how you maximize it? You maximize it by choosing what is called policy. So policy is as a prescription, is a function which tells you, like, what you should do at each point in time over your course of action, given the state of the world, right? So translating it to financial setting, what's the state of the world? So let's translate it to, setting of portfolio trading. For portfolio trading, the state of the world will be a concatenation of two vectors, essentially. One is your personal information, which means that the state of your portfolio allocations, right? And the second part of this vector will be like all the observables from the market, essentially. That's how you conceptualize what happens in the world, which consists of your own world and the external world, right? So that's the state of the market. And the actions would be portfolio trades, changes in your portfolio. All right. So we define two things. Now we have to define what we call the rewards, like what do we maximize? And here you have multiple choices, right? So some people maximize the Sharpe ratio. Some people maximize returns. Some people maximize risk-adjusted returns. So there are some people, minimize the tail risk, for example. There are multiple combinations of how you can define it. And not all of them are equal, because some of them are more tractable, some are less tractable. I prefer tractable.
Sure.
Yes. So that's the direct reinforcement learning. Now, so once we understand that, we can now define what we call by inverse reinforcement learning. So in direct reinforcement learning, again, you start with the definition. You define what you want to maximize. You define this reward function, and this reward function is a function of two things: of your state vector and your actions. All right, normally, right? So you specify it, and then you try to optimize your policy in order to maximize the total reward. In inverse reinforcement learning, why it's called inverse? Because the situation here, your inputs are inversed. So you don't know what your reward function is. What you are given a history of actions by some other agent. It can be like a person, algorithm, whatever. But you basically take the history of portfolio trades made by someone, for example, right? And you don't know what was like the objective of these trades. But you rather have offline, data set of portfolio states, market conditions at that time, and portfolio trades, actions, right? And then you look at this data and you try to understand like what was the objective of portfolio trades. Right. So this whole discipline of inverse reinforcement learning actually originated in robotics. So first papers which were written on this topic, I think they were in the area of robotics. Yeah, maybe I should say a few words about like what's the ultimate goal. So the ultimate goal of inverse reinforcement learning is first to understand what was actually optimized to infer this reward function, and then use this inferred reward function in order to again optimize your policy. Because at the end you want to either replicate what was done or maybe improve over what was done, right? So, and now why in robotics people were so interested in that? So like one of the examples that I saw about applications of these things in robotics was this thing. Imagine that you want to teach a robot to do something. So like one of the demos that I saw videos was a robot takes a glass of water and it needs to move this glass of water somewhere and then pour this water, right? So imagine this, like how you would train your robot to do this using direct reinforcement learning. You would say, okay, I decompose this whole motion into small steps. Yeah. And I define a reward function for each one of these steps, right? In theory. In practice, how you would do this, like how you would actually define it, very, very hard. So maybe instead of that, we would do like something like, learning by demonstration. We would take a robot's arm by human's arm and do it literally like that. So we will show it what to do. And then we will say, okay, this is your history, and then now go learn this reward function implied by this optimal action. You already showed the robot how to do this optimally, right? And sometimes it's a more feasible task, if you wish. So this is a situation in robotics. In finance, situation may be not as ambiguous, because usually in finance we kind of know what we want to optimize, right? As I said. Right. So like the choices are kind of countable at least, right? Not infinite. Okay, yeah. So you can optimize Sharpe ratio, Sartino ratio, or risk-adjusted return or something like that. But still there is some freedom. Still there is some freedom. And so like one of the ideas that we tried to check was the idea of whether we can learn from actual trades made by portfolio managers. And then we have to define what we mean by learning. So there are two choices here. Sometimes people talk about fund replication, right? Which is something that is feasible in this framework as well. So normally when people talk about fund replication, they don't mean any, fancy stuff like inverse learning. Nevertheless, you can apply these concepts here. So you would say, in this approach, you would say, okay, I observe the history of portfolio trades and portfolio states as well, and then I apply some algorithms from this inverse reinforcement learning family to learn the reward function. And this will give me the objective function for direct reinforcement learning. Like if I already learned the reward function,
Yes, then I use it.
and I know what I should optimize. But here there is a very, very, interesting caveat, not caveat, a tricky point, I would say. The tricky point is this. It's very critical what kind of inverse reinforcement learning algorithm you use here, because most of them, those initial algorithms that I first got familiar with by reading papers, they already assumed that what you see is an optimal action. If you assume that, so first of all, in robotics, it's a plausible assumption. In finance, it's never a right assumption, right? Because you can never be certain that what you saw was optimal. There is no such thing. In finance, you can only rank different things. Okay, this portfolio manager was better than the other one based on performance. That's it. That's about it. So if you start with the assumption that what you saw was optimal, then the best you can hope for would be fund replication, not improvement, not any sort of improvement, because you already assume that what you saw, like at best you can replicate.
Right.
And even then it will be like lagging, because it would be like lacking because of time lags, etc. Right? So it doesn't sound so exciting. However, so we wrote two papers. In the first paper, we published both in risk. In the first paper, I was not aware of these better ways to do inverse reinforcement learning. So the first paper applied other methods, like less sophisticated ones, to some simulated setting of wealth management. But when I started to think about how to apply it to fund management, then I came across a recent paper. Back then, it was a recent paper written by researchers from Washington University in 2019. The paper itself was about games, not about finance.
Okay.
But they came up with a very neat method for inverse reinforcement learning, which does not make this critical assumption that what you saw was optimal. And it was based on ranking. On ranking different trajectories, exactly as I said, right? So if you think of portfolio history as a trajectory, some sort of trajectory, right? So then you can say, okay, or returns, whatever, like P&L, and then you can say, okay, so I have two histories of two portfolio managers, and one was better than another. Can I design a reward function such that it would, reflect on this property, that my reward function should be such that, it should tell me that the first trajectory with better Sharpe ratio, better return is actually better than the second one in terms of this one-step reward function. So what's important about that is that this method captures the intent, not the result, but rather the intent of what they were trying to do. And as long as that's the case, then you already have a hope to improve over what you saw. You see? So this makes it already much more interesting. Right? And in these experiments that we did, we saw exactly that. So we basically, what we took actual fund managers, like group them by types of funds that they have, essentially group them by benchmark, and then trained our model separately for each group of funds. The reward function along the lines that I described it, we use some very simple model of rewards, something like very caricature representation of what actual fund managers do, in a sense of tracking the benchmark, minimizing the volatility, minimizing transaction costs on very few five parameters total we had, right? And then you take the data, you infer these five parameters, and you say, now I know the reward function, so now I can do in the backtest I can check my hypothesis that if I already learned this reward function, will I perform better than the actual fund managers? And we found that yes, I mean, yes and no, in the sense that we our model performed better than the average of these fund managers. It did not outperform the best of them, which is, I mean, it's like, it's still good, right?
Of
It's
course.
still, yeah, still interesting result. Okay, it was very long answer to your first question. The second question, what's happening and what can be done, it's tricky in my perception. Maybe we can talk, like, maybe we should differentiate, like, these days people, again, talk a lot about reinforcement learning,
Yes.
but in relation to LLMs, not in relation to reinforcement learning that we did with that.
Yes. Most of it is LLM related. You're right. Yeah.
Yes, correct. So we can touch later about LLM, but first I wanted to say a few words about reinforcement learning applied to trading
Yes. Yes.
numbers, right? So obviously, the industry is very secretive. So, like, you hear rumors here and there, and you have conversations, but not much is published. I had number of conversations with people who reached out to me personally, shared their experience with reinforcement learning. And I guess the pattern that I saw there was kind of mixed. In what sense? Many people used to tell me, okay, we tried that. Initially, it didn't work, but then it started to work, and we did, we had positive P&L for a while, and then it stopped working again, and we didn't understand why. Very few firms, I think, put reinforcement learning frameworks in production.
Okay.
I think, like, my former employer, JP Morgan, put RL framework for option portfolio trading. They made quite a splash with that. It was, I think, done in 2020. Hedge funds, I'm not sure if they, like, some of who of them and how much they use it. And sporadically, they tried it. I've heard at some point that some hedge funds had lots of success with reinforcement learning, and then again, everyone started to talk about that, and then it faded away. My take on this is that that was the reason why I mentioned to you that I prefer simple
Mm.
approaches, right? So the meaning of that, now I can maybe explain what I mean by that. What I mean by that was the following. If your reward function is simple enough, then you actually don't need deep neural networks to implement your reinforcement learning. When people talk about reinforcement learning, they have a tendency to jump immediately into what is called deep reinforcement, which I think is a very shaky, path, shaky grounds. Why? Because, deep networks, black box type of things, they have like local minima, etc. They are very kind of hard to make them work, in a stable way. So that's why most of the things that I did in these experiments, and not all of them, but most of them, I did in a different setting where your reward function is simple enough. And what I mean by simple enough is very specific. So I mentioned to you that it's a function of two variables, the state variables and action variables. So if this reward function is a quadratic function of action variables, it can be arbitrary as a function of state variables, but it should be quadratic as a function of action variables. If that's the case, then you can simplify things dramatically. And essentially, you can proceed without using neural nets altogether. It was actually known. It's not that I discovered that. It was known for people in stochastic optimal control for a while, but then I kind of rediscovered it for myself. So if that's the case, then essentially your reinforcement learning reduces to just a bunch of linear algebra. Everything is controllable,
Mm-hmm.
right? Which is a great thing.
Fantastic. Yeah.
Yeah, because you understand exactly what's going on at each stage,
Yep.
each step. Now, is it like a kind of miracle solution or not? No, it's not, because, like, so if your reward function, let's say you use, like, you can frame Markowitz optimal portfolio theory in the language of reinforcement learning by applying Markowitz. So what's Markowitz reward is a risk-adjusted return, right? So you take expected return and you subtract from it like standard deviation of your portfolio with some coefficient or variance better, right? And you call it risk-adjusted reward. So if you stick to that, then it will have this property that if you like look into what it implies, it will have this property that this reward is exactly quadratic in your portfolio, in your trading variables, in your actions, and you can proceed to the end. So that's great. This is what I used in couple of my papers. If, on the other hand, you say, no, 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 it's not good for me, I want to capture maybe like it's like as a measure of risk, maybe I want to use CVAR, not the variance of the P&L, but rather CVAR, then you can't proceed in this way. Then you have to use neural nets, etc. Yeah, so it's like a short summary that's tricky. It's tricky, right? But the tricky part here is more or less the tricky part which is inherited from deep neural nets themselves, not due to reinforcement learning.
Yeah, yeah, yeah. Understood.
I mean, it adds because, like, there are more moving parts in reinforcement learning. You have to approximate policies, and then you have to, depending on how you frame it, you have multiple neural nets, one for policy, another one for value function, blah, blah, blah. So obviously that's complexity.
Yeah.
And that's why, some people, like, for example, Jan LeCun, he's promoting the idea that actually we shouldn't use reinforcement learning. We should rather use what is called model predictive control, MCP, which essentially does the same thing, but in a more tractable way, in more, so there are some conversations now whether, people who do reinforcement learning with LLM should also use this model predictive control.
Ah, I see. I see. Some
Yes.
comment. Okay. Okay. I was going to come back to that, but before I do that, because I was listening, it was like maybe last week or something, to an interview with LeCun. And he was explicitly asked. I think it was just generated by this interest that got a huge impetus after the Turing Award of 2024 was given to Sutton and brought to for the reinforcement learning. But so the main topic of conversation with him was what he thought about reinforcement learning and the success, not necessarily in finance, but a general conversation. And he was, I wouldn't say he was dismissive, but he was thinking more along the lines of efficiency arguments, that these kind of things are not, we can do more efficient things that will solve the same problem. He wasn't too specific about the nature of the solution, whether the solution is the same or not, or it is better solution or worse solution. But implied by his argument was that we can get the same results, but we can get them through what he called the self-supervised learning. So, in which there is no supervisor to label things for you, very much like reinforcement learning in spirit, that you kind of interact somehow with things, with the samples, let's say, and then you yourself learn the labels of those samples, and then you proceed moving on and on and on based on that. You teach yourself. Yeah. So that was going to come. But before I do that, let's perhaps open this to the audience to see if audience have any questions. So if you have any questions, please just unmute and ask, because there aren't too many people, so I don't need to moderate. So if you have any questions, please just unmute and ask. But I have so many that I can't fit it in this time. But just in case, I just want to give this opportunity to everyone.
So here with us, your class, is it your class that you teach?
This one, no. This is just for the community, for the whole entire community.
Oh, okay.
So then we put this on the community forum, and then people go and watch, and then they come have conversations, discussions on that, and so on. It's a much bigger community, around right 2,600 people.
I see.
But my class, no, my class is something like 34 people.
Mhm.
And so far we have been doing the first 5 chapters of Prado book, really basically, so I can see how they complement each other, these two textbooks. My only fear is that I won't be able to get to a point in one semester to cover every, which is impossible. Even one of the books would be impossible to cover in one. If
Absolutely, yeah, totally
knowledge.
agree. Totally agree.
But from his perspective of going to the minutest thing about, like, oh, should you even work with time bar data as opposed to volume bar data or dollar bar? Should you form your bars every minute or every $10,000 or every, I don't know, 5,000 transactions? And then how they are different. So very, very, I don't want to say micro level, but very under the hood, the mechanical part of the, and then comes all these neural net approaches, reinforcement learning and all that. And my own experience, incidentally, while people are thinking about questions with reinforcement learning, I was at UPenn after my PhD for 2 years of postdoctoral fellowship in the math department. When I was there, I had lots of interactions with people in electrical engineering and computer science. So most of my interaction ended up being with a group that was working with hybrid dynamical systems and hybrid control theory and so on and so forth. So I like to work with them, but there was the group around Michael Kearns. Yeah,
Yes,
he had a student, Nev
I
something.
know Nivaka. Yes, yes,
Yeah, yeah.
yes.
So he
I know
wrote
this
it.
guy.
Right, he wrote a thesis on this market microstructure. Through you look at the limit order book, and you have this reinforcement learning agent who is actually learning and interacting with that and placing bets.
Yes.
So it was fantastic book. I read the PhD thesis. I talked to Michael a little bit about this. He was also very busy with Burns, some companies that
He
got
was at Morgan Stanley.
Morgan Stanley, yeah. And then, yeah,
Yes.
he was at Morgan Stanley. And then they had this trading agent competitions, and they were very much into this stuff. And then just after Bear Stearns bankruptcy, I guess they stopped, and they were getting the support from them for the UPenn project for trading agents. So everything stopped. But that was my first encounter with that, which was very attractive to me, not simply because of financial applications and how neat this application was in the market microstructure world, but because of control theory, which was my main background. I mean, I loved it that control theory was manifesting itself this.
Yes, exactly, exactly. Yeah, yeah, yeah. Yes, yeah. I was very much inspired by actually by this paper of him that you
Yeah.
mentioned, and also by one of his presentations. I attended one of his presentations, I remember. It was exactly around these times when I was thinking about how to apply reinforcement learning to the problem of option hedging and pricing.
Uh-huh.
And then he said something like, he said, "Oh, there is a little secret why all these machine learning methods work." He said that the key is to make the total loss function additive. And I thought, wow, additive. Oh, okay. It gives me an idea immediately, like what I should put in
Yeah.
my reward to make it additive from the number of steps. So, yeah. By the way, I was told by someone that actually they wrote this very first paper about using of reinforcement learning. They used it in their hedge fund and then they lost lots of money.
Oh,
Yes.
oh,
So
well.
yes, yeah, there was some problem maybe with the initial formulation or whatever, but nevertheless, yeah, nevertheless, his student is now running a machine learning group at Morgan Stanley.
Oh,
You,
okay.
yeah, yeah, I met him
Yeah. Interesting.
recently. Yes.
So I have one question here in the chat. It says, thanks a lot for sharing. Hi, Igor. Thanks a lot for sharing your experience and views with us. May I ask if you have implemented live RL for portfolio rebalancing or portfolio sizing in general? If so, could you please share some takeaways?
The short answer is no, we didn't get to this, unfortunately. So one of the reasons was this, right? So as I mentioned, where I work, we deal with the fundamental fund managers, and they don't trade that often, right? So unlike intraday trading or high frequency trading, we don't have much data. And what it means in practice is that is that you have to somehow, like, you can't operate at the level of individual stock positions. You simply don't have that much data to work. So what we did, like this work that I described, was done at some level of aggregation. So we did some sort of dimension reduction in order to make it workable. And there are multiple ways to do this dimension reduction. We aggregated in the paper that we published, we aggregated to the level of sector exposure. So instead of a portfolio, in dimension of 1,000 by the number of, US stocks, if you in the Russell 1000 universe, you reduce it to the portfolio in dimension of 11 by the number of industrial sectors, right? And then you also reduce the trades to the same language. So both your action and state space become 11 dimensional. So rebalancing was done like in this space. Right.
In the reduced space.
Yes, in the reduced space. As I said, like I would love to try it, for stock rebalancing, but that would take a different data.
And meanwhile,
thank you for sharing.
Go ahead.
I asked the question, and I'm working at global level cross asset, and we are exploring such approach. I'm quite interested by what you said about inverted real. So I think I will deep dive in your paper to understand better how that works. If you can share the reference of the paper, it would be quite useful, because I started to Google it, but you wrote so many papers. Thank you.
Yeah, absolutely. Yeah, feel free to reach out. I'll be happy to answer questions if you have any. You can connect with me on LinkedIn. Share my email here.
Yep, that would be great. Thank you. So we don't have much time. Oh, we are out of time. So let me ask one question maybe two questions very quickly, because I think one will be very, very useful for everybody else who is watching, especially younger people who are coming up, aspiring quants, especially those who, most people, I'm assuming these days, who are going to get a job will likely be touching on machine learning techniques of some form or shape. So it is hard to imagine that you go get hired and you are never in the quant world and you never even have encounters with ML. So what advice or recommendations do you have for, young aspiring quants moving into careers in whether hedge funds or investment banking or trading houses and things like that? In terms of experience, what to read, how to prepare themselves better, what to pay more attention to?
Great question. I don't know, frankly. I would like a general recommendation would be, which is like universal, not specific even to machine learning. Just take a particular project and try to implement it, right? Like one of the advices that I read when I was back in physics was like, we all pressed with time, right? So we all have to operate under time constraints. So like the model of learning from 19th century or 20th century, when you take your time, spend the semester reading book from back to back, is not working. So you have to reasonably cut some corners. The question is like how you do it in such a way that you still keep the focus, right? So one of the good advices that I saw was this advice, right? So pick a project and then spend a little time trying to do it on your own, right? Like chances are that you'll get stuck at some point very quickly. But if you do it this way, you will have very focused questions. Like you will get stuck specifically on, I don't know how to do this, and I don't know how to do this, right? And then you will go to books or courses or whatever, you find specific answer to these questions. As opposed to linearly reading the book, right? So that was my experience when I came to industry. I didn't know any programming. Because in academia, I only programmed a little bit in Mathematica, but when I went to Bloomberg, we had to program in C, so I had to learn C. And initially, I just took Carnegie and Ritchie book and started to read it slow, slow, slow. And I saw that my manager is getting impatient. I have to do something. So then I just took someone's code, right, and started, to read this code, modified it to my need, right, hacking, essentially. Then I did the same thing with, deep learning libraries. You take someone's code and you hack it. You specifically find, things that you have to tune. It saves lots of time.
Yes. Yeah. Yeah.
Yeah. But having said that, if you overdo this, then you would not get, the basics, right? So it should be some optimal point here.
You're absolutely right. So some foundational building, but then need-based progression on that foundation, because otherwise, if there is no foundation, eventually it will tumble down. But
Yes.
but not just building the foundation. It reminds me of the joke that they always say that, three people go and they are given the assignment to write about elephants. And so this is one British and German and let's say American. And so the British has written something like, I don't know, 200 pages, and it's called Elephants. And that's it. Very dull and very, I mean, it's just what it is, and 200 pages. And then American perhaps has produced something called Elephants for Dummies or something, which is 50, 60 pages. The German comes with 3 volumes, Introduction to Elephantology 1 and 2.
Yes.
So if you go that Germanic way, there is no end. I mean, you will just reading and reading and reading, never getting to the, yeah.
Yeah, exactly.
Need-based is very important. So my last question is, if you were to write a sequel, perhaps, to this book, or if
Yeah.
you were to rewrite this book now, starting now, how different do you imagine it to be?
It's actually a very practical question. We've been talking about that, whether we should have a second edition. Like, I would add few things in my sections on reinforcement learning, right? There are new algorithms. Some of them came from LLM, so probably we would add something on LLM as well. It can easily take the whole book, as we can imagine, right? So sticking to the same format. So it would be like new algorithms in reinforcement learning, obviously, right? And then something that I already mentioned, this model predictive control,
Yeah. Mm-hmm.
right? These things. And what else? I mean, yes. So like since then I had like couple of additional papers that I wrote. So one of them was about how you do reinforcement learning in continuous time. In continuous time, instead of, it gives you lots of advantages, due to the, that's why people did, differential equations in the 19th century, because when you deal with continuous things in time and space, then you get, lots of tractability, right? So it turns out that the same applies to reinforcement learning. You can do reinforcement learning in continuous time, in continuous space, and this amounts to differential equations. I have a paper which actually does exactly that. So it combines this continuous time approach to reinforcement learning with neural nets. So basically, this is what it's called scientific ML, right? Which is a new thing which was developed after we wrote the book, essentially, right? But it's essentially like how you use neural nets as approximators to solving differential equations.
Right, right. Yes.
Yeah, which is a great topic. I really like it because, like because it gives you the ability to leverage all like it's very much in the spirit of our book, right? So machine learning is not, it was not created in vacuum. It has foundations in classical science, right? In math, in financial theory, right? And this gives you this link, right? So you reduce something to differential equations, but now you have new ways to solve these equations
Exactly.
using neural nets, right?
Exactly. Exactly.
Yeah, that would be definitely something to add. The other thing would be like a bit less related to the topic of this conversation, but still part of my research is deals with the model in the market dynamics itself,
Mhm.
dynamics of financial markets. It connects to the topic of reinforcement learning
Uh,
at the point of what you already mentioned, right? So efficiency, right? So if you do classical reinforcement learning, it's model independent, which is good thing, but the flip side is that it's very inefficient, data inefficient, as opposed to model-based approaches when you say, no, I don't want to like be totally like, I do want to use some model for dynamics. I take some risk that my model is misspecified, but nevertheless, it gives me like lots of efficiency, right? So yeah, so this is like how these two things connect. And I had some recent research about, new interest in nonlinear models of market dynamics, which is another of my favorite topics. And like at some point, if I would have a bandwidth, I would like to, put them together.
And these are already published articles that
Yes.
those who are
Yeah.
interested can find on archive.
Yeah. They're on archive on SSRN. Yeah, we have a nice name for this. We called it Marketron. There is a
Oh,
perceptron,
yeah.
the Dictron. We call it Marketron.
Oh,
Yeah.
that's a very nice name. Yeah, it fits nicely with
Yes.
what you have. Yeah, it really fits nicely. All right, wonderful. Well, this was really a very pleasant, very wonderful conversation. Thank you very much for spending this time with us tonight, and all the best wishes to you.
Thank
Uh,
you so much.
and to thank you to everybody who was here and listening, and hope everybody who is listening to this and wasn't here. So Igor, as he said, more than happy to get in touch. LinkedIn would probably be the best way.
Yes,
Oh,
absolutely. Yes.
yeah.
Yeah.
And then
Link.
all the papers on our archive and Cornell archive and SSRN. So you can find those papers there and study further along. Well, thank you very much and have a great week and good night.